think we have to first recognize that this has been the longest bull run in history, at least from the Dow's perspective and the developed world perspective. So we had the Lehman collapse and the great financial crisis in 2008, September actually, that's the trigger date that people remember, when Lehman Brothers declared bankruptcy on September 15, 2008. And then we had the collapse of the markets around the world, including India, with green shoots actually reappearing or some chance of a recovery in the world markets from March 9th, 2009. So for about 6 months, the markets were really in very, very poor shape. So from March 2009 till recently, we've had pretty much a one-way ticket and just the market running up and all. Because I think the first thing to recognize is that we've had a phenomenal, longest bull run in recorded history in the markets. Again, the developed markets, not true for all emerging markets because they've had their ups and downs, but in the developed world, the longest bull run in recorded history. So, given that we've had the longest bull run in history, and the longest bull run in history has been not because companies or countries have had phenomenal rates of growth and phenomenal rate of growth in corporate profits. It's really been because central banks around the world have been printing money, and the cost of money in many economies of the world is actually negative, i.e., if I'm a saver and I put money into a German bond, a German government bond, or a Swiss government bond, I actually have to pay the government money to keep my money with them for 3 years or 5 years or for 7 years. So I'm paying them 0.5%. I give them 100 today. And after 5 years, I get back 99.5. So recognize that a lot of this bull run in asset prices, which we just spoke about as the longest in history in the developed market, has been because money has been cheap. So when you get money in your hand as a business person or as a consumer, you either decide to spend it in a business person will decide to invest it, or everyone decides to speculate. And when you speculate, you push up prices of existing assets like property, like bonds, like stocks, and they get to new heights. So everyone was waiting for something to go wrong before the market would correct. So it's been expected for many, many, many years that the market is due for a correction. But no one knew that a virus whose diameter is less than 1,000th of your diameter of your hair, of one strand of human hair, that such a small organism would frighten the world, destabilize financial markets, and cause a crash. So what caused this crash, the coronavirus, that in some sense you could consider as a black swan event as to what caused it. But should the market have started correcting? Yes. 3, 4, 5, 6 years ago, people have been expecting that this bull run should have ended, but it never did. It would have a small hiccup and go back again, another small hiccup, and then the Federal Reserve and other central banks of the world would print more money and the markets would again go up. So you've had this issue that it needs to come down, and we don't know what's going to make it come down. Something wrong with governments or policy or trade wars, and then the virus comes, small little thing, smaller than the diameter of a strand of your hair, and that brings the market down. So it'll be huge in the sense that what's happened again is that there's been very low GDP growth rate over the last decade around the world. There has been very low employment or wage growth rate around the world. And in countries like India and in many other parts of the world, employment creation or job creation has not been very good, largely because of, for example, automation and new technologies have reduced the needs for certain kind of jobs, and people are still being born every day or getting ready to be employed every day. So I think the impact on the global economy will be significant. Also, on a direct comparison basis, leisure travel, people traveling on holidays, people traveling on vacation, and business travel, where you have seminars, conferences, launches of products around the world, these account for roughly 4% of global GDP. So global GDP is about $60 trillion US. And to put that in perspective, that's about 20 times the size of India's GDP, a little more than 20 times the size of India's GDP. So if global GDP is going to be 65 trillion US dollars, and about roughly $2 trillion is being knocked off directly because people are cancelling planes, they're cancelling huge events, Geneva Auto Show, New York Auto Show, IPL cricket matches, all sorts of stuff have been granted. Football matches for those who love football. So a lot of things around the world have been cancelled. The Olympics in Japan is supposed to start now in the month of July. I mean, so far Japan has indicated that it will still go on. But imagine if the Olympics were actually cancelled. All the investments that were made in the Olympic infrastructure, in all these different sports infrastructures that exist around the world, they have bills to pay. They borrowed money to build the infrastructure. There are bills to be paid to the banks. The banks expect the interest to come. If there are no seats being sold in football stadiums or cricket stadiums or Olympic stadiums, how do you get the revenue to pay the bills? So there will be a cascading effect on the economy, which is a function of how long more this virus will actually carry on, or as many people expect, it will fade away and die off by the summer. The summer means in the Western world, by the month of June and July, the temperatures increase rapidly to where we are in India today. And when that happens, they're expecting that the impact of the virus spreading will actually decline. While the market started correcting around February or so, when news started spreading that the virus had actually started growing more outside China than it was necessarily growing within China. So the markets already started correcting for that, because supply chain is another issue. A lot of the global multinational companies have supply bases in different parts of the world, but primarily in Asia. And the fear was if that in many parts of Asia get infected, how will the supply of various components reach the consumers that need to consume them and the factories that are in between. So you had the markets correcting, and then on March 9th, Monday, the Saudis, who lead the OPEC oil cartel, they had called for a meeting in Vienna with the Russians, who are not part of the cartel, but they set the prices. So the price of oil had peaked at about $114 a barrel about 6-7 years ago, and was in the $60 to $55 barrel range till about December 2019, so a few months ago. And it was slipping because of the slowdown in China. China is a huge consumer. And Saudis and the Russians and OPEC said, let's try to limit our production. So when you reduce supply, you keep prices up. Apparently the Russians said, we're not going to play ball, and we don't want to do it. Now, if you're a Saudi oil producer, and they're the largest in the world, you're able to see from your customer base that oil prices, or rather oil demand, is slipping. So probably the Saudis said, fine, if the Russians are not playing ball, we just increase our total volume of production. We will have longer term contracts with those who want our oil, whether it's China or whether it's India, whoever it is, and we'll drop our price of oil to get those long term contracts. So on March 9th, in the Asian markets, before the US opened, the Asian markets, the price of oil collapsed by the most it's done since 1991. And when price of oil fell to $30 per barrel of oil, the markets got extremely nervous, because they said, look, oil indicates whether there is economic activity or not. So if the Saudis are saying that we are dropping the price of oil to win your business, they probably are seeing that demand is falling dramatically, and therefore they want to lock in your business. And if they are seeing that, things must be a lot worse than what the market has already tried to estimate or factor in. So in a complete panic, there was like everyone across the world started selling, starting from Tokyo. And by the time London opened and Europe opened and New York opened, the markets were all completely collapsing. So it was oil that has brought the markets down. Now, from an Indian perspective, we feel a little happy, saying that, look, India imports oil, and because we import oil, the price of oil has come down. That's very good for us. It means we have to spend less of our FX reserves, which we have at the RBI, to buy this oil, and therefore it will help our current account deficit, and we look pretty good. Also, if price of oil comes down, the price of oil comes down, we can reduce the selling price of petrol at the gas stations, and that makes consumers a little happy because they're paying less, and therefore they can spend the money on something else. So when they spend the money on something else, that adds to economic activity. So if you spend the money on high oil products, you're really giving money to Saudi Arabia. But if you spend the money, that extra money on something else, you can give money to an Indian company. So that was kind of the expectation within India. But I think that's a little wrong, because if you think about it, India has a total trade of roughly $1 trillion. So about 40% of our total GDP is imports plus exports, of which our import bill is roughly about $500 billion US dollars or so. And if we save this price of oil, we'll save some money there, but then we're also exporting to the world. But if the world slows down dramatically, then our exports may get hit. Then the profitability of those companies which export products will get hit. The government will collect less taxes from those companies. So on one hand, we will have to pay less for the oil, which is a positive. On the other hand, the slower economic activity around the world will actually hurt the government and hurt their ability to collect taxes and spend more to get the economy moving. So it may not be that big a benefit from the Indian context. I'd like to just maybe add another thing, is that in terms of oil, so when the Saudis and the Russians did this, it's a little more it may be a little more complex than that. In the US, you've got shale oil, and the shale oil is a big US creation, and it's brought the price of oil down, like I mentioned, $140 a barrel 6-7 years ago, down to about 50-60 till a few months ago. But if at $40 a barrel, shale oil in America doesn't really be that economical. So if the shale oil producers in America close down, then it's possible that the price of oil again can go up in the world. So we don't know whether the Saudis have done this to hurt the Russians, or whether the Saudis have done this to hurt the Americans. Now, in America, there's an election year. Donald Trump is a Republican. Republicans control Texas. Texas has a lot of oil in that area, and they have to fund elections. They're not going to be very happy if they see that the price of oil has come down and they're supposed to fund, the sitting president for re-election. So there could be some pressure on the Saudis to say, hey, what you guys doing? I'm Donald Trump, I'm your best friend, and you're just about to hurt me on a chance of re-election. So can you take the price of oil back up again? So these are other little things that may happen, which are, again, out of India's control. We just take the price, whatever is given to us in the world market. But keep a lookout for oil, because oil will have an impact on the mood of the market and how the market perceives energy consumption and therefore future GDP output. If energy consumption is assumed to be low and prices fall, then markets will get nervous, because that implies GDP will be low and therefore corporate profits will be low. Therefore, why should stock prices be going up? They should be going down. So there are a bunch of things, right? One is, of course, I mentioned oil, so that's the economic thing. The other thing is that within India, you have GDP that's also being, in any case, has been very slow. And now we're being told, rightfully so, to stay at home, to spend less time outside, to minimize socializing. And of course, travel has stopped. Travel into India has stopped. And therefore, if Swiss or Lufthansa or British Airways cannot bring passengers into India, then their planes don't come here, and then no one from India can fly out. So flights have been cancelled, kind of all across the world, actually. It will hurt India for sure. It will hurt India to the fact that we'll have much lower economic activity. It will hurt India to the fact that we will not have the potential of encouraging foreign travel into India now. So it happened at the tail end of our tourist season. So we're lucky. Our tourist season is normally November to March. So this has happened at the tail end of that. So we've been lucky. But next tourist season, I doubt people are going to be that much in a hurry to book tickets to Asia. Not only India, but to all of Asia. They may end up being closer to home, given all the destabilization that they've seen now. In terms of the, the assumption being made here is that there is no pandemic in India, that it doesn't spread widely, and that because of the good things that the government has done of controlling inward bound traffic and trying to limit the way we move around and trying to encourage us, to kind of stay and work from home, etc., it will limit the damage in India. And if that happens, then we're okay. There'll be some kind of a slowdown. But if it spreads across India, which we know the next week or two, then it could have a much more lasting impact. How difficult will be very difficult to say till we know what that is. So I think in terms of safety, the government's been very proactive and has moved very quickly to ensure that people who are coming in from outside are kind of frozen to some extent. Now, I was traveling and I came back a week ago, just after they announced that they would be screening at the airports. So the screening at the airports is like a thermal gun, to kind of check your temperature, which is nice, but it doesn't do much because you could be carrying the symptom with you. You could be carrying the virus with you without actually showing the symptoms for quite a few days. It could be incubating within you. So the fact that you have that thermal gun is all right, but doesn't serve the full purpose. And we have to wait and see what happens now. If over the next week or 10 days, if the number of cases don't increase rapidly in India, then we're okay from a safety perspective. From an economic perspective, I think there will be a hit on India for a bunch of reasons. One is that it was lucky that the virus and the rules that came into play about banning foreign tourist travel to India happened towards the end of our tourism cycle. So we normally have a November to March tourism cycle. We're already in March and this happened like a week or so ago. So it's come at the end of the cycle. So that's kind of okay. The question is to be raised is what will happen next tourist cycle on international tourism. Domestic tourism anyway is going to be hit. People planning for the summer holidays, which start in India, May, June, July, traveling trips within India, they will not be making those trips. The people traveling outside India definitely will not plan any trips either. So there'll be a bit of freeze on activity. We're being asked, rightfully so, not to go to malls, not to go to crowded areas, not to go to movie theaters, not to travel unless you really have to travel. So all that slows economic activity a lot. And in a way, that's very good. It's good for you to spend time with your family and with your friends, whether on the internet, on the phone, or whatever it is, rather than travel and consume and spend all the time. But at the same time, the Indian economy has been in a real big mess for years. And policy making has been relatively weak. We've not been able to get out of the financial mess that was kind of peaked, if you will, at the ILFS crisis. We've still got a real estate mess with a lot of unsold inventory across the country in all the metros. We've not been able to solve that problem. We've had a slowing economy because of all this in general, lower financing available, lower consumption patterns, lower economic activity. And now economic activity will obviously be a lot lower too. There is no advantage to economic activity if you're sitting in your home and chatting with your parents. It doesn't add to GDP. It does add to Bhutan's calculation of gross national happiness. That it does. So you're looking at happiness, yeah, it probably does add to that, but not to GDP. So there will be a hurt on India. And even in terms of import-export, the fact that, global consumption is slowing, Indian exports will slow, Indian imports will slow. So anyone involved in any kind of supply distribution chain business, the air freight kind of distribution business, the trucking business, all that will slow down dramatically in our view for the next few months. So the impact has been pretty harsh. And just like in the developed world where you've had the markets kind of run up mostly on cheap money, in India, the markets have not moved on economic or earnings fundamentals per se. They've really moved on the availability of risk money from overseas, which wants to allocate to Indian stocks. That has driven markets. And local investors who seeing the bank deposit interest rates coming down, who've been encouraged, rightfully so, to move their money into equity mutual funds. So these have been the two big sort of drivers, flows of money, domestic, and flows of money from international investors, not earnings. So Pre-demonetization, November 2016, the markets were at the 30,000-ish kind of levels. Then you had demonetization, and that was not a good thing for the economy at all. And then on July 2017, you had the introduction of GST, which was another, in our view, very bad policy that was announced of the Indian economy. And the reason it was bad, to take a few seconds on that, was that we believe that GST has a unified sales tax, when really what they should have done was removed octroi. Octroi is a tax you pay when the goods crosses borders, and that has slowed down, the time that it takes for goods to move from Maharashtra to Karnataka, or Maharashtra to Goa, Maharashtra to MP. And there's always friction. When you have longer time, you have friction. The friction is someone at the gate at each border who demands his share of the cut to let the goods go through. So that had gone on. That was fantastic. But then to have a nationalized unified tax was not, but that's not a discussion. So GST was not a bummer, if you will, for the economy. So we're kind of back to those index levels. And I think it's interesting to note that between the time of Prime Minister Modi's first election win in May 2014 and now, so pretty much over the last 6 years nearly, the index has risen very sharply, the BSE 30 index. But 66% of the rise of the index has really come from 3 stocks. 66% of the rise of the BSE 30 index has come from 3 out of 30 stocks in the BSE 30 index. So 10% of the stocks have accounted for 2/3 of the rise of the index. HDFC Bank, Reliance, and HDFC. These 3 stocks have accounted for the major move of the index. So it tells you that there's something wrong with the overall economy. It's too narrow. A bit like in the Western world, you've had what they call the FANG stocks, which have moved, the tech-driven stocks that have driven the NASDAQ, that have driven the market, that have powered the gains, much of the gains in the Western world. So the Netflix, the Googles, the Alphabet, etc., Apple, etc. So the markets have now come down to those sort of levels, demonetization, GST, that level. And that was about 5 years ago, 4.5 years ago, 4 years ago. So between then and now, the earnings of companies have grown by about maybe 15% over that 3-4 year time horizon. So I'm buying the market today at the same price as it was 3.5-4 years ago, and the market's giving me 15% more in earnings. So I'm actually getting it 15% cheaper than what it was 3-4 years ago. Of course, you don't buy shares for the earnings they gave you in the past. You buy shares for the earnings they give you in the future. So to that extent, you have to now say, okay, the market's inexpensive. It's down to very good levels. But what does that tell me about the future earnings of the economy? And that's still a very big unknown. The government is still not got its act together on coming up with a solid, sensible, believable, achievable game plan on the Indian economy. They tinker with this, they tinker with that, they announce a budget and they modify things, but there's no big concerted effort to say, hey, this is what we need to do. And the markets have been waiting for that. And it hasn't yet been sort of delivered, if you will. So until we're sure about when that recovery of GDP happens, we cannot be sure about when the recovery of corporate earnings will happen. And therefore, how do I decide whether I should buy the market at a 30,000 level or wherever it is, or should I wait? So our argument has been, well, over the next 2-3 years, you hope that this government figures out what's to be done. And if they don't find the market kind of self-corrects, or the economy self-corrects and goes into what we call a cyclical recovery, where the cycle on its own, you do not take medicines from a doctor when you're ill, you let the body kind of figure out how to heal itself, and you get to some level of healthiness. May not be the best as if you went to a doctor, but you get to some level of healthiness. So if the government can't give us that prescription, that boost shot to get the economy going, we cyclically recover, right? So it's not the best recovery, but it's okay, we'll go for some time. So given that there'll be some cyclical recovery over the next couple of years, it would make sense to allocate money to the stock markets. We've often said that there's an asset allocation table you should follow, and we've said that at these levels, the markets we thought were a little expensive. So yes, have equity, but keep some money aside. And I know that's what I'm doing for my portfolio, my personal portfolio. I've started moving money away from the safer quantum liquid fund into the riskier quantum equity mutual funds, because I see the market levels to be attractive, and on a 2-3 year view, that to me is like a reasonable expectation that the market prices of shares will recover again. So I go back to what I write at the bottom of every honest truth, that there's an asset allocation statement. And I'll tell you what I do. So I look at my monthly expenditures, and I keep between 24 months to 36 months of what I need to spend every month into what I call the safe bucket, the safe money. And I don't think banks, in my view, are particularly safe. So I keep some money, of course, in banks because we all have bank accounts. But I consider a liquid fund, in this specifically my case, I put money in the quantum liquid fund as my safety money. Because the risk of your money being in a bank and the government suddenly telling you, well, we've just taken over this bank and the FDs are frozen for the next 6 months or 6 weeks is pretty high these days. Whereas in a liquid fund, well, it doesn't happen because you give a liquid fund the money, you give quantum liquid fund money, it takes that money and buys government securities with it. It doesn't buy bonds issued by private companies. It only buys bonds issued by the government or by government-owned companies. So it puts money in that, and then when you want it, it sells that and gives it back to you. So there's a T+1 or T+2 time process to get your money back, but then it's there, so it's there. So I keep my 2 years or 3 years expenditure money in that. And the rest I've been splitting primarily 80-20. So 80% in equity and 20% in gold. And then the 80% equity that I have has been, in general, over 3 quantum mutual funds. So I used to say, and I have spoken about this at many Paths to Profits, that 80 to 90% of the money that I have in equity mutual funds is in the long-term value fund, because I'm a value investor. And the rest of it I kept in the quantum equity fund of funds. When I tell investors, you all should do the reverse. Out of that big equity pile of 80, you should keep a little bit of that in quantum long-term equity fund and keep a lot more in the quantum equity fund of funds, which invest in the stock market based upon how other fund managers pick their stocks. So in that you may have a growth or momentum or multi-cap or large cap and small cap and mid cap, and there's a whole basket. So by getting that quantum equity fund of funds, you've got exposure to 6 of the 200, 300, 400 equity mutual funds out there, which Quantum has studied, researched, and then picked the best that they think work for a portfolio. So you get that exposure. And then the Quantum Long-Term Value Fund is a specific style of investment, which is a value style investment, which honestly hasn't worked very well for the last 15, 16 months. And there is an honest truth on that also. So that's what I would do. I would just keep 2 to 3 years money in liquid funds, and I would keep 80% of the balance in equity funds and 20% of the balance in a gold fund. And that would be my allocation. And the reason I've got the 24 to 36 months is that in moments like this, when I think the markets are attractive, I'm willing to take a risk, and I'm willing to take some of that safe money away from the quantum liquid fund and move it into the equity product. Because I think the rates of return, the risk return ratio is very much in my favor for the next couple of years if I make that investment. And also, of course, these days, no one's shaking hands, so it's always namaste. And it used to be, namaste means that the God in me greets the God in you. I think the namaste nowadays means if you got the virus, keep it to yourself. So anyway, namaste.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.